Hello students, this is Dr. Chetna Kumawat. We are understanding cost of capital. In order to understand cost of capital, we must know the significance of this concept. The cost of capital is a very important concept in the financial decision making. The progressive management always likes to consider the cost of capital while taking a financial decision, as it is very relevant in the following spheres. Designing the capital structure. The cost of capital is a significant factor in designing a balanced and optimal capital structure of a firm. In designing a capital structure of a firm, the management has to consider the objective of maximizing the value of the firm and minimizing the cost of capital. By comparing the various specific costs of different sources of capital, the financial manager can select the best and the most economical source of finance and can design a sound and balanced capital structure. Capital budgeting decisions. The cost of capital serves as a very useful tool in the process of making capital budgeting decisions. The acceptance or rejection of any investment proposal depends upon the cost of capital. A proposal shall not be accepted till its rate of return is greater than the cost of capital. In various methods of discounted cash flows of capital budgeting, cost of capital measures the financial performance and determines the acceptability of all investment proposals by discounting the cash flows. Comparative study of source of financing. There are various sources of financing a project. Out of there, which source should be used at a particular point of time is to be decided by comparing the cost of different sources of financing. The source which bears the minimum cost of capital would be selected. Although cost of capital is an important factor in such decisions, but equally important are the considerations of retaining control and of avoiding risks. Evaluation of financial performance of top management. Cost of capital can be used to evaluate the financial performance of the top executives. Such an evaluation can be done by comparing the actual profitability of the project undertaken with the actual cost of capital of funds raised to finance the project. If the actual profitability of the project is more than the actual cost of capital, the performance can be evaluated as satisfactory. Knowledge of firms' expected income and inherent risk. Investors can know the firm's expected income and risk inherent therein by cost of capital. If a firm's cost of capital is high, it means the firm's present rate of earnings is less. Risk is more and capital structure is imbalanced. In such situations, investors expect higher rate of return. Financing and dividend decisions. The concept of capital can be conveniently employed as a tool in making other important financial decisions. On this basis, decisions can be taken regarding dividend policy, capitalization of profits, and selection of sources of working capital. Let's take a look on classification of cost of capital. Historical cost and future cost. Historical cost represents the cost which has already been incurred for financing a project. It is calculated on the basis of past data. Future cost refers to the expected cost of funds to be raised for financing a project. Historical costs help in predicting the future costs and provide an evaluation of the past performance when compared with the standard cost. In financial decisions, future costs are more relevant than historical costs. A specific cost and composite cost. Specific cost refers to the cost of a specific source of capital, such as equity share, preference share, debentures, retained earning, and so on. Composite cost of capital refers to the combined cost of various sources of finance. In other words, it is the weighted average cost of capital. It is also termed as overall cost of capital. While evaluating a capital expenditure proposal, the composite cost of capital should be used as an acceptance or rejection criteria. When capital from more than one source is employed in the business, it is the composite cost which should be considered for decision making and not the specific cost. But where capital from only one source is employed in the business, the specific cost of that source of capital alone must be considered. Average cost and marginal cost. Average cost of capital refers to the weighted average cost of capital calculated on the basis of cost of each source of capital, and weights are assigned to them in the ratio of their share to total capital funds. Marginal cost of capital is the cost of obtaining another rupee of new capital. When a firm raises additional capital from only one source, not different sources, then marginal cost is the specific or explicit cost. Marginal cost is considered most important in capital budgeting and financing decisions. Marginal cost tends to increase proportionately as the amount of debt increases. Explicit cost and implicit cost. Explicit cost refers to the discount rate which equates the present value of cash inflows with the present value of cash outflows or value of investment. Thus, the explicit cost of capital is the internal rate of return which a firm pays for procuring the finances. If a firm takes interest-free loans, its explicit cost will be 0% as no cash outflow in the form of interest are involved. Implicit cost represents the rate of return which can be earned by investing the funds in alternative investments. In other words, the opportunity cost of the funds is the implicit cost. It may be defined as the rate of return with the best investment opportunity for the firm and its shareholders that will be foregone if the projects presently under consideration by the firm were accepted. Thus, implicit cost arises only when funds are invested somewhere, otherwise not. For example, the implicit cost of retained earning is the rate of return which the shareholders could have earned by investing these funds if the company would have distributed these earnings to them as dividends. Therefore, explicit cost will arise only when funds are raised, whereas implicit cost arises when they are used. Certain assumptions of cost of capital are also there. While computing the cost of capital, the following assumptions are made. The cost can be either explicit or implicit, as already explained. The financial and business risks are not affected by investing in new investment proposals. The firm's capital structure remains unchanged. Cost of each source of capital is determined on an after-tax basis, and cost of previously obtained capital are not relevant for computing the cost of capital to be raised from a specific source. So this is it for today's lecture. Thank you for your patience and listening to it.